Hello and welcome. My name is Dave Schiller, the founder of Aegis Wealth Partners, a fee-only financial planning firm in Phoenix, Arizona. I'm a CFP practitioner and college planning expert. In addition to the CFP, I hold the Certified College Financial Consultant designation in addition to several others. The CCFC is a post-CFP designation that deals specifically with education funding, financial aid planning, education tax credits and deductions, and student loan advising. What we'll be talking about today is really a complicated subject that is often confusing to many families, and it is expected family contribution, or EFC. We'll go over the different types of EFC, how they're valued, which schools use them, and that is really going to set the table for the next several videos where we start to explore case studies and how we can try to manage EFC to create the most favorable financial aid situations for our family. So expected family contribution, or EFC, there are three different methodologies: the federal EFC, the institutional EFC, and the consensus EFC. Different schools use different methodologies. The federal EFC, you have to fill out the FAFSA form for federal aid, and that's what the federal EFC helps determine, is the amount of federal aid you are eligible for. This is used exclusively by most universities, and when I mean exclusively, most universities only use the federal EFC. There are schools that will use multiple EFCs depending on which school it is. But for most schools, they do use only the federal EFC. EFC in general takes into account both income and assets for the parents and student alike. It is the least invasive in terms of the financial information that it asks for. And it's determined by what is called prior year. And this is really important. I don't think it needs to be said, but just in case, don't lie on this form. The penalties for fraud include fines and jail time, and that goes for all of the EFC and the forms that you need to fill out for financial aid. So very important that we're as honest as possible. Okay, so for the federal EFC, this is used to determine federal aid eligibility. So it's not necessarily what you will be paying, but rather what type of federal aid eligibility, what that number is going to be for your family. The FAFSA form, again, is how we determine federal EFC. It is available every year on October 1st. It's important to know that this is a first come, first served basis. And the types of federal aid that a family would be eligible for are scholarships and grants, work-study programs, as well as direct federal loans, whether they be subsidized or unsubsidized. As I mentioned, it uses a prior year to determine EFC. So that means that the tax and financial information 2 years prior to the first semester of school are used. So the example that I will use here and also in other videos, for a student that is attending college in the fall of 2024, the income for 2022 tax year will be used. So essentially, for a graduating senior, it will be their sophomore year. So before the sophomore year is really when you can do the most income and asset planning to really set up your base EFC. This is where you want to optimize the EFC to make your family look the most eligible for federal aid. Again, the FAFSA form is filled out each year, so it is actually not too late, even if you haven't begun planning before by the time your student's a sophomore in high school. There are things that you can do to increase your EFC after the first year. So this is where what is also important to understand for EFC. There are things that you can do to help manage or decrease your EFC, but there are also things that if you do or don't do, you can increase your EFC as well. So It's very important to understand really the ins and outs of how EFC is measured, the timing of when EFC is calculated to make your family the most aid eligible as possible. So on the income and asset side for the parent, the federal EFC will assess anywhere between 22 and 47% of income, and then up to 5.64% of assets. For the student, there is an allowance for the 2023-24 school year at $7,600. Anything above that will be assessed at 50% towards EFC. For the 2024-25 school year, that number does jump to $9,400, and then anything above that, 50% will go towards the EFC. You do see on the student asset side, 20% of assets are counted towards the federal EFC, so that's a pretty big number there. So there are allowances for income and assets, some of which I just mentioned. But they will be changing with something that is called the FAFSA Simplification Act. I'll be doing a completely separate video on the FAFSA Simplification Act. But before I do that, I just wanted to set up what EFCs are before I get into what the changes of the act, how it will impact EFC. Parent asset protection allowance will be gone after the 2023-24 year. Or for the 2023-24 year. Student income allowance will increase, as we saw on the previous slide, and the parent allowance will also be increasing to 20%. So some pros and some cons there. And in terms of the assets that federal EFC and the other EFCs take into account, bank accounts, so checking, savings, CDs, money markets, also taxable brokerage accounts, 529 and prepaid college plans are actually assessed. So depending on if they're owned by parents or the dependent student, they'll be assessed at a different value. UGMA and UTMA accounts, so these are essentially trust accounts that are held in the student name, and when they turn the age of majority, the control of the asset then goes to the student. They are assessed as well. Trusts where the parent and the student are the beneficiary, investment, real estate, and property as well. In addition, so there's going to be some changes here, but currently the net worth or the net value of a family business with over 100 employees is assessed for the federal EFC. But you'll see for the 2024-25 school year, this is where the FAFSA Simplification Act kicks in. The net value of a family business, regardless of the number of employees, will be assessed. Again, this is another completely separate video topic that I'll be putting out, because now what we're looking at is this is impacting really essentially anyone who has a small business or is self-employed, whereas prior it was only some of the larger businesses with over 100%. So the number of small business owners that are impacted is going to significantly increase. And again, we'll address that in a later video, but just be aware that soon the valuation and assessment for businesses will change. Family farms will also be assessed in 2024-25. Currently they're not. And child support will also be assessed. So excluded assets, retirement accounts such as 401ks, 403bs, IRAs. The thing to know about a 401k or a 403b. So you may be thinking ahead already and saying, well, I'm going to go ahead and I'm going to max out my 401k or my 403b on a pre-tax basis to set up my base EFC. Well, unfortunately, what happens is they will actually back that pre-tax contribution and include that in your income for federal EFC. So on your tax return, it's a great benefit, but it actually isn't going to be helping you for your federal EFC. Again, certain family businesses and family farms are currently excluded Annuities and life insurance, for the most part, are excluded. Personal items like cars and boats, other types of watercraft, as well as your personal residence, are all excluded from the federal EFC model. So just a brief discussion of the FAFSA Simplification Act. It goes into effect 2024-25 academic year. It was supposed to go into effect a year earlier, but it was pushed back. So there are some pros and cons here. One of them is certainly it is simplified in the sense that rather than 108 questions, we're going to see 36. So it will take less time, ideally, to fill this form out. You'll be able to import your tax information, so much quicker, and also help to reduce any errors. They will expand Pell Grants and other types of federal aid, so you'll see an expansion of Pell Grants. There will be some income and asset assessment changes. A big thing for some families is that there will be no multiple child discount. We'll go into that a little bit later, but this is something that is pretty important and will impact quite a few families. And then EFC will actually be renamed the Student Aid Indicator. So hopefully this the topic of EFC isn't too confusing, but we're also going to see a name change. So we'll try to keep this as simple as we can now and going forward. Okay, so now the institutional EFC. So this requires something called the CSS profile. It's something that's put out through the College Board. So many families watching this will be more than familiar with the College Board, and that's where you can find information on the CSS profile. If you are looking for eligibility for federal aid, you still need to fill out the FAFSA form because the CSS profile is only assessing the family in terms of aid that actual institution that you're applying to is going to be offering. It's used by approximately 200 universities, and then for another 200, it's an optional assessment. The CSS profile looks deeper into income and assets, so it's a little more invasive. Again, it's not for federal aid. You need to fill out the FAFSA form if you want to receive any financial aid, including the direct federal loans. These are institutional resources that are used to help students. There is a $25 application fee, and currently it's $16 for additional schools. We see the income and asset assessment calculations. So very similar on the parent side, 22 to 46%. But on the asset side, it's a little bit lower, up to 5%. The parent rate is 46% for the student income. And then on the student asset side, it's a bit higher at 25%. So income and asset calculations are different for each school. So the previous slide is kind of the guideline for how schools are looking to assess families' eligibility for their aid from that university. But they all tend to focus on slightly different things and they weigh things differently. So just understand that it is different for each school. It'll be similar, but it is different. There are several income and asset allowances. A big thing here is that home equity is generally included in the assessment. And then many schools, however, are starting to require the CSS profile only one time as an incoming freshman. So that will help simplify things, but it will also make it more important that if you are able to manage your EFC for that base year, that you really nail it and make the most out of your opportunity there. The FAFSA form, however, is filled out every year. So there is a much greater disclosure of financial information. And the specific disclosures can vary quite a bit between schools. So as I mentioned, the better that you've managed your EFC, the greater the potential aid that you can receive. And that's in addition to the federal aid that you could be eligible for, assuming you filled out the FAFSA form. The aid is generally given in scholarships and grants. So these are, this is money that does not need to be repaid. So well worth it to fill out that form and make those disclosures. So as I mentioned, there are specific disclosures that are required by different schools. When you're filling out the CSS profile, every question will either say required or it won't say required. So if it says required, you have to fill it out. And if you're going to be applying to, say, 5 schools that use the CSS profile, those required answers are going to go to all those schools. And you want, as I said before, you don't want to lie, you want to be honest, but you also don't want to overestimate some of your assets, also your future income. So particularly your home values. So right now, as I'm recording this, Arizona has seen a big spike in home values. Not the time to be bragging. So, use what you believe is the proper home valuation, but don't overinflate it, because if you're trying to impress someone, you're only going to end up hurting yourself when it comes to aid eligibility. So for the questions that are required, again, you need to fill those out. But if it isn't required, then you don't need to answer it. You can be rest assured that if a school is interested in a specific topic, they will ask you for additional questions. And sometimes what you'll see at the end of the CSS profile, for example, you may see a university that you've applied to that after you fill out the questionnaire, you think, okay, great, I'm done. But then a couple of questions will pop up and it will say what university is asking for certain data. So, but you can be rest assured, even if you don't fill out those required questions, if the school wants the answer to that question, they will ask you, they will request verification. So the suggestion is just go ahead and answer the question when the school asks. Otherwise, it will go to every school and you may end up hurting yourself in terms of your EFC for a school that was unintended. And again, remember, this is because every school makes their valuations differently. Okay, so the consensus method, this is used by approximately 20 schools. They are members of the 568 Presidents Group. The 568 Presidents Group is are schools that have said they are committed to providing aid on a need blind basis. This is a list of those schools. It's actually 21 that I have on this list. So some very prestigious national universities, as well as some very prestigious liberal arts colleges. So you can see, again, the parent income and assets are very similar to both the federal and institutional methodology. Income about 50% here for the student. But the real big difference for this methodology compared to the others is that student assets are assessed at 5%, so quite a bit lower. Also, the home equity, while it's used for the institutional methodology, for the consensus methodology, it is capped at 120% of parent income. So if income for the family is at $100,000, home equity is going to be capped at $120,000, even if it's higher. So again, I'm based here. I'm based in Arizona. I live in Arizona. For those of you who are watching in Arizona in 2022, you may have experienced a situation where your home equity is quite a bit higher than than $120,000. So for the consensus methodology, there is a cap on that. So that is very helpful in helping to lower your EFC compared to the institutional method. Okay, so a couple of takeaways. As we've seen, the income is treated pretty similarly. It's where the student assets are concerned. That's where we see a pretty big difference. The federal methodology at 20%, the institutional method at 25%. But then at the consensus method, we see it drop all the way to 5%. if you're trying to plan your income by using tax losses and deductions, generally, you can do that for the federal methodology. It will be helpful. But a lot of times it's going to be added back for the institutional and the consensus method. So depending on where your student may be applying, what you think their chances of getting into certain schools are, just be aware of how that will work, and, just think about that carefully, and, talk to your tax planner to make sure that that what you're doing makes sense for each of these EFCs. And again, the tax for tax planning, that's a different story, but for financial aid planning, then it's a consideration to keep in mind. And then the institutional methodology, it calculates a minimum student contribution of $2,000. An allowance isn't specified, but it does appear to be similar to the federal methodology. But just know that for the institutional methodology, there is that minimum contribution on the student side. Okay, so I mentioned the multiple student discount. So you see, when you have the EFC for the federal methodology, so let's just call it $10,000, or let's call it $20,000. So if you have one student in college, it's going to be your EFC for that one student at the federal level is going to be $20,000. But if you have two students in college, then you're going to cut that in half. So it's going to be $10,000 for the two students, and then down the line, a third for three students, a quarter for four students. But starting with the FAFSA Simplification Act, that is going to go away. And regardless of how many students you have in college, you're going to use that same federal methodology, federal EFC. And then we look at the institutional methodology. We see that we do have that discount for multiple students. Expected family contribution, again, be mindful of how income and assets are assessed. There are some things that can help you with the federal methodology, but it could hurt you with the institutional and consensus method. And, once you've determined your EFC, and then you understand, what type of student you have, your student could be an elite performer, 4.0 or higher. They've killed the SAT, ACT tests, so clearly a high merit student. Maybe they're kind of a middle of the road, maybe they're a good to middle of the road student. But once you've assessed your EFC, now you can begin to really start to plan what schools should we be looking at. Should we really be looking at the schools that offer merit aid? Should we really be looking at the schools that offer needs-based aid? Maybe your student is a candidate for both. So there's, again, once you understand what your EFC is and knowing, what type of student you have, there's kind of a strategy that you can apply to try to figure out which schools that maybe are not on our list, the types of schools that we should start to target and see if those might be good options that could give us a really generous financial aid package. Okay, so the first step, I would suggest grab your college money report. So in 5 minutes, you can find out how much tuition you're pre-approved for, what's your EFC, and then what's the funding gap. And what you'll be able to do is you can find out this information for 3 different schools of your choosing. So maybe you have a list of schools that you want to see, well, where do we stand with these schools right now without making any adjustments to our EFC? Or maybe you just want to see, okay, well, what does an in-state public school look like for us? What does an out-of-state public school look like? And then what does a private school look like? That's actually what I'll be focusing on for the next couple of videos. I'm going to take a case study for a family, and we're going to look at an in-state school. We're going to look at an out-of-state public school, and then we're going to look at a private school. And as we go through some different scenarios of trying to manage EFC, we're going to see the impact on EFC for the different types of school and how it impacts financial aid eligibility. But you can get a head start on understanding where you and your students stand by getting your college money report. You can get it right here on our channel. If you go to the About section, there's a link called College Money Report. You can get it right there. Also, if you do have some questions, I have a contact form, a link to a contact form. You can reach out and ask your questions. Or if you would just want to go to our website, aegiswealth.net, you can, there's a contact form there where you can reach out, but also on the resources tab, if you go to the first sub tab, it's called College Money Report. There's a little bit of information on what the report offers, and then you can get it from there as well. So a couple places where you can get that information. Like I said, it's free. You're going to have a lot more information than you may have already as far as where your family stands, and it takes just a couple of minutes to do so. So I hope you found this video helpful. For the next couple of videos, as I said, we're going to be doing case studies. So we're going to see how some of the ideas of trying to manage EFC are actually put into practice, and what the implications are for the various schools that we look at, and how that changes aid eligibility, and ultimately how that drives the cost of college down for our family that we're going to be following. So if you want to get notified when these new videos are coming out, because we're going to have quite a few coming out here over the next several weeks and months, click subscribe. That way you'll get notified right away. But thanks for watching, and until the next time, we'll see you on the next video. All right, well, take care, everyone.